Hi everyone, this is the online lecture for money and the banking system. This is the OCL week, so lecture will be covered online. Now, what we're learning today, we're going to explain the function of money, and we're going to talk about the money supply in Singapore, and we're going to talk about how money is created under what we call the fractional reserve system. Okay, there will be a calculation part for lecture today. We have to calculate the money multiplier and how money is created in the economy. Now, money is defined as any asset universally accepted as a medium of exchange. Okay, now sellers accept it for payment, creditors accept it for payment for debts. Now, in this chapter, our definition of money can be very precise. Okay, and that is largely decided by the central bank about how we define money. Now, the definition could be a bit different from how laymen perceive as money, about what is money and what is not. Okay, we'll talk about that a bit later. But let's take a look at what money does for us. Now, there are four functions of money: medium of exchange, unit of account, store of value, standard of deferred payment. Now, please remember the four functions of money. Okay, it tells us what is the use of money to us. Now, money can be used as a medium of exchange, exchange for goods and services. Okay, now can you imagine a world without money? If you don't use money to pay for things, then how do you get pay for what you want? To get what you want, how do you make a payment? Now, in the olden days, without money, people actually had to barter. That means based on what the seller wants, you go and find the goods that the seller wants, and then you do a exchange. Okay, that is both very time consuming and it's not a very productive way of exchange of goods and services. Okay, so money gives us a medium of exchange that we don't have to go and find the goods that the other party wants. In the olden days, money started off not as notes. It started off by being a precious metal, okay, silver or gold, okay, where it's used to pay for things. Okay, nowadays we have notes that's issued by the central bank. Okay, advantage of course of notes is that it's easier to carry. Okay, using precious metals can be very cumbersome because it's heavy. Now, money is used to measure value, acting as a unit of account in the same way as we use Celsius to measure temperature, we use kilometers to measure distance. So, money is used to measure the value of goods and services. All right. So it helps, it functions, provide the function of a unit of account that way. Now, money also serves as a store of value. Now, otherwise, if you are a farmer that you produce meat, the meat will go back quite fast. Money is quite a good store of value, assuming that there's low inflation. Value is largely sustained in money, okay, compared to a perishable good. All right. Now, just take note that if let's say there is hyperinflation, the value of money will also disappear very quickly. Okay, so we are assuming that there's low inflation, that money can function as a store of value. Money is also used as a standard of deferred payment. So when you pay your installment and you pay later, money is used as a standard for making those payments. Now, what is money? These are some of the things that we use from time to time. Your checks, cash cards, credit card, debit cards, Nets card. Yeah? But which of these are money? Actually, all these are not money. Okay, they are just instruments of payments. Okay, an instrument in which we use to make payment for goods and services. They're not really counted as money. Okay, now this two might seem a little bit close and confusing. When we come to the definition of money, you'll be able to understand it in greater detail. Okay. Now, what is money supply? Money supply is the total stock of money in the economy at any point in time. Okay, and that's controlled by the central bank, which we will bring out a while later. So let's take a look at what constitutes money supply in an economy. Now let's take a look at Singapore's money supply. Okay, now we usually define money in the form of M measurements, M something. Okay, now the smallest of the definition or the smallest parameter will be M1. M1 consists of demand deposits, which is your current account, known as current account, or currency in active circulation. Now, what's currency in active circulation? The notes and coins that you are currently using. Okay, those are currency in active circulation. What do we mean by active circulation? That means when you buy things, you pay the seller pay the supplier buys something and pays somebody else. It's circulating around the economy. Okay, so those are part of M1 along with the checking accounts in the banks. Okay, now because these two are frequently used for making payments, so they are the most narrow form of what we describe as money, known as M1. Now M2 adds something else to M1. M2 is a wider definition of money. It includes M1, we talked about M1 earlier, demand deposits and currency in active circulation. There's also this added thing on quasi money. Quasi means half real kind of money. Now, what is quasi money? Now, it refers to your savings deposits, your fixed deposits, your NCDs, we'll talk about that later, and other deposit with commercial banks. Okay, these are accounts that we don't usually use to make payments on a day-to-day basis. Okay, so we call it quasi money. All right, so this comes under M2. So M2 is a bit wider. It consists of M1 plus this quasi money. Now M3 is the widest and most general definition of money. It involves M2, that means M1 or so, plus net deposit with non-bank financial institutions. Okay, non-bank financial institutions could be like insurance companies. Okay, now if you look at M1, M2, and M3, you realize that as we go higher up the number, M1, M2, and M3, the additional components in the definition becomes further and further away from us and not the usual means of making day-to-day payments. Okay, but they're nevertheless still defined as money. For example, when you buy insurance, that amount is still counted as money. The amount that you deposit with insurance companies is still counted as money, but under M3, net deposit with non-bank financial institutions. Okay, now most countries use similar M1, M2, M3 system to describe and to set the parameter of what they define as money, but it can differ from country to country. So if you're using the parking textbook to read, the money aggregates, the M1, M2, M3 that they define will be a bit different because they're talking about the US system. Okay, Singapore is a little bit different. Most countries use similar with a system with a little bit of variation. Okay. Now, just now we talked about what is NCD. NCD is your negotiable certificate of deposit. Now, what is it? Now, some companies want to pay cash to another company, and the amount could be very large. Now, they also don't want to pay huge stacks of cash. Now, our Singapore dollar usually what you can find the largest note is $1,000. So let's say if company A wants to pay company B a large amount like $300,000 in cash, what they do is that they go and get NCD. Okay, so on the NCD it will be like $300,000 they can pay to another company. Okay, directly. So NCD are actually some kind of cash, but in very large denomination that's usually not present in the currency in active circulation. So this is a look at Singapore's money supply. M1 is the most narrow definition of money. It focuses on the function of money as a medium of exchange that's very close to us when we make payments. So it involves the checking accounts, the demand deposits, as well as the currency in active circulation, the notes and coins that we use to make payments. So it's very close to us. As it becomes wider and wider, it tends to become further and further from the usual payments that we make. Okay, so M2 and M3 are broad definitions of money and focuses on money's function as a store of value. You remember your deposits with non-bank financial institution, which is part of M3. Okay, those are like you buy insurance policies, you deposit money with the insurance companies. So it focuses on money's role as a store of value. Okay, because you are investing for the future, so it focuses the role as a store of value. Now, this is an example of the money supply of Singapore in 2009. The amounts are shown. Now, let's take a look at money supply, total money supply in Singapore in a more pictorial form. Let's take a look. So, for money supply, you have a M1, which is your currency in active circulation and your demand deposits equivalent to that amount. And then you add another big chunk, with the quasi money. The quasi money is your various deposits as well as your NCDs, and we just talked about that. Okay, your quasi money is much more, 264 billion, okay, compared to 85 billion M1, okay, more than twice. So together, your M2 is about 349 billion, thereabouts, yeah. Now you add on to the final component in M3, which is your net deposit with financial companies. So your total money supply, which is M1, M2, add together will give you M3. Yeah? Your M3 will be more than 357 million that is circulating in the economy. Now, who controls this money supply? Who decides how much that should be circulating and who controls it? Now, in any banking structure, right at the top of in the control of money supply would be the central bank. Okay, the central bank is a government body. It's not a bank as we know. Like they open accounts for you and things like that. This is a government organization. It's a central bank. Okay, its role is to control financial institutions, inclusive of commercial banks. Okay, and commercial banks lend out money to individuals and corporate. Okay, so the central bank control all these money supply and money movements in the economy. Okay, now so the central bank is a very powerful government institution in any country because money is such an important tool in the economy. Now, the thing about central bank is that it's never known as a central bank. It always has different names. Okay, in Singapore, our central bank is called the Monetary Authority of Singapore. Okay, in US is known as the Federal Reserve. In UK is known as the Bank of England. What is the name of the central bank for your project country? Go and check it out. It could be quite interesting. But for our central bank in Singapore, MAS, it regulates and controls our monetary policy, which we will learn next week. And what is its mission? Its mission is to promote sustained and non-inflationary economic growth, okay, and also to foster a sound and progressive financial services sector. So they help to regulate economic growth and keeping price level in check. Doesn't want price to go up too high or too fast. Okay. If you want to know more about our central bank, you can go on the website to take a look and see whether they have a career page, see whether you want to work there after your life in TP. Now, so where does money come from? If you look at the notes and coins in your wallet, where do they come from? Now, there's a difference between a layman perception of how money is created and in econs. Okay. Now, money is not created by just printing it per se. All right. Of course, you need to print some money to circulate in the economy for transaction purposes. But money is effectively created by bank lending, whereby accounts become multiplied through bank lending, commercial bank lending. We will illustrate the process later. Okay, but it's important that you understand how money is created through this money creation process. Now, first we're going to understand how do commercial banks function. Now, commercial banks are your regular banks like DBS, OCBC, UOB. Okay, these are commercial banks. They are uh, um, commercial businesses that operates as a business to make money. Okay, now so how do they operate? Now, basically, they will take in deposits from customers, and then they will hold part of it as reserve and lend out the rest. Okay, now why do commercial banks need to lend out? Otherwise, how do they make money? Okay, so what they do is they accept deposits from people and then they lend it out against to others who need it, and then they charge interest rate on the money lent out. That's how they make money. Now, if you go and look at the interest rates that's paid by commercial banks, they will pay you less and charge more for what they lend out. So they earn the differential in interest rates. Okay, so that's how they survive. All right. So how do they manage all this money in and out? Fractional reserve banking means that they will hold reserves. Okay, there's less than the amount of total deposits collected, which means that if you deposit $100 into the bank does not keep the $100 in the bank all the time. It will lend out part of it and keep part of it, okay, keeping it just in case, okay, but it will lend out a part of it to earn money. All right, that's how they survive. All right, so that's fractional reserve banking. Now, commercial bank lending as well as fractional reserve banking is tightly controlled by the central bank, which is a government body. So it's tightly controlled by the central bank. Now, the central bank imposes a required reserve ratio. Sometimes in newspaper you read is also known as cash ratio. Okay, now this is law. Every bank must maintain a certain percentage of the deposits as reserves. That means the bank, out of the deposits that they collect from customers, they must keep a certain percentage as hard cash within the bank. All right, so this is mandated by the central bank. You cannot bargain, you cannot say no. All right, and the rule is applied uniformly in the entire banking sector. Okay, so central bank will set a certain ratio, and all the banks must follow and keep that ratio in the form of hard cash in the vault. Now, some banks are very careful and very cautious. They will keep more than what they are required to. Okay, now as an example, if the central bank says you must keep 10% of your total deposit as cash, some banks are worried, what if I have more than usual customers that line up and wants to withdraw money? So they may be keeping more than 10%, they may be keeping 20 or even 30%. So the extra reserves that they keep on top of the required reserves are known as excess reserves. Okay, are known as excess reserve. Okay, which is in excess of the required reserves. Now, this is how we can visualize deposits and reserves that's being kept in the bank. Now, before the bank lend out, all the deposits that it collects are its reserves. Okay, all the amount that it collects from customers deposits are its reserves. Now, of course, it will not keep all the amount like that and don't do anything about it, otherwise they won't earn anything. Yeah, so what they do, they will start to lend out. Therefore, out of the total reserves that it has, that means out of the total amount of deposits that it has taken from customers, it will be required to keep a certain amount as mandated by the central bank. Okay, so this part of the deposits they collect from customers, it must keep inside the bank just in case. Okay, which means that it can lend out the rest. All right, so these are excess reserves available for loans. So a commercial bank only need to keep this part. Okay, but of course they may keep more, but you cannot keep lesser than this required reserve because it is mandated by the central bank, which is law. Okay, now let's have a short exercise. A commercial bank received $100 in deposit, and the required reserve ratio set by the central bank is 10%. So what is the required reserve in dollars? So 10% of the $100 deposit means that the bank has to keep $10 as its required reserves. Now, therefore, how much can the bank lend out maximum to make money? So, of course, the rest. So, it's required to keep $10 with it so it can lend out the rest. Therefore, it can lend out the rest of the $90. Okay? Now, how much excess reserves would there be if the bank only lend out 70? Now, just now we say that it can lend out $90, but when it only lend out 70, it will have some excess left over. The excess reserve would be $20. Okay, so this is how we look at the entire fractional reserve banking in perspective. Now, remember earlier when we defined what is money, you saw that there were a lot of definition of money that involved accounts. Okay, now this is where it gets tied into commercial bank lending. When commercial bank lend out money, okay, is actually increasing the number of accounts and therefore increasing money supply. Okay, which we will look at how it works a bit later. This is known as the money multiplier process. Okay, the amount of money that is supplied in the economy gets multiplied whenever commercial banks lend out money. Let's take a look at how it works. Now, to show the money creation process, we use the T account. Some of you may have learned accounting for this semester, but it's okay if you have not. We will look at the process slowly. Now, before we start, we have some assumptions. We assume that there's a $100 deposit with a certain bank called Bank A. And we define the required reserve ratio as 10%, okay, set by the central bank. And we assume that the bank lend out whatever that they legally can. That means other than the required reserve ratio that they're supposed to keep, they lend out the rest. Okay, let's take a look at how they create money this way. Now, this is the balance sheet for Bank A. Now, balance sheet records the liabilities and assets of a bank. Okay, when a person deposits $100 into Bank A, it's recorded under the liability side because this amount is not the bank's, it's the customers. Okay, depositing there only, so it's not the bank's. So the bank owe the customer this $100. Okay, so it's recorded under liabilities. But at the same time, because of this deposit, the bank gained cash of $100, which becomes its reserves. Okay, so now the bank will keep R, the required reserve ratio of $10. Remember, we say that the required reserve ratio is 10%. So the bank keeps $10 as reserves and lend out the rest of the $90. Okay, now someone will come and borrow the $90 from Bank A. And the person who borrowed $90 from Bank A has his own bank, Bank B. And the money, $90, get deposited into Bank B. So Bank B will have new deposits of $90 and also cash reserves of $90. So now Bank B will begin to lend out money too. Now, can you see what's happening so far? When the bank lend out money, the number of accounts in terms of deposits is multiplying. Okay, from the first time that the person deposit $100 with Bank A, we now have $100 in Bank A of deposit. They lend out $90 to somebody else, and that somebody else now deposit $90 in Bank B. So from an initial $100 deposit, the total deposits is now at $190. And you can see that the process is nowhere near completed yet, and you will go on. Okay, let's go back to the process and take a look. Now, so Bank B now have deposits of $90, and they will begin to lend out after setting aside the required reserve ratio of 10% of $90, which is $9. So they will lend out the rest of the $81. Okay, now someone else will come and borrow the $81 and then open an account somewhere else. Okay, and the process goes on and on and on. So let's assume that that someone who borrowed the $81 go to his own account at Bank C, and Bank C has a new deposit of $81, which means that it can lend out 72.9, and the process goes on and on and on. Now, this is a table to show how the process will carry on. Now, from the first deposit in Bank A of $100, the bank kept $10 as required reserve and lent out 90. So the $90 went to Bank B when someone borrowed the money and opened a new account in Bank B. And Bank B could lend out $81 after setting aside $9. So someone took the $81 loan and went to Bank C. Okay, and then go on and on and on. Now at the end of the whole process, okay, new money of $900 will have been created. Okay, out of the initial injections of $100. Okay, now in the exam or in any test, you don't have to do T accounts until the end of time. So we have a shortcut to calculate how much money can be created whenever there's a new deposit that's being made in the banking system. Okay, a shortcut. Using this formula, okay, money multiplier is equals to 1 over required reserve ratio. Okay, we are assuming that there's no leakages. We'll explain leakages a bit later, and banks lend out whatever that they can. Okay, there's some multiplying effect whenever a new deposit is being made when banks lend out money. Okay, so we'll calculate the money multiplier. Okay, and using it to multiply by the initial excess reserve that the bank can lend out. Okay, that will give us the new money created. Let's go and take a look at an example. Now assume that the required reserve ratio is set at 20% and a person deposit $100 into a commercial bank. Let's take a look at how money is being created this way. Now first calculate what is the multiplying effect. So what is the multiplier? Now we take 1 over 0.2. Now take note, when we calculate the value of the multiplier, the required reserve ratio, we have to use ratio, okay? 0.2. We cannot use percentage 20, 0.2. Okay, we have to use 0.2. And the value of the multiplier is 5. Now it's a multiplier, so the number cannot be smaller than 1. Okay, so it's usually quite a larger number. Okay, so 1 over 0.2 is 5. So there's a multiplying effect of 5 times. Now we calculate how much new money can be created by using the second formula. So we take 5, which is what we calculated earlier, times the initial excess reserve that the bank can lend out. Now the bank cannot lend out the full $100. You must take out the triple R first, the required reserve ratio first. Okay, so the bank can only lend out 80% of $100. So the bank can only lend out $80. So 80 times 5, total of $400 will be created from this initial deposit of $100. Okay, so you calculate the multiplier first, okay, using the ratio derived from the triple R, required reserve ratio. Okay, and you use it to multiply by the initial excess reserve, the first time that the bank can lend out in full. So 80% of $100 is $400. Okay. Now, what is the relationship between the required reserve ratio that's set by the bank and the multiplier? That means, does the required reserve ratio set by the central bank has an impact on the amount of new money that's being created in the banking system? Now, banks can only create money when they lend out. So the more you allow them to lend out, the more money will be created. Okay. Now, so if the required reserve ratio is 10%, 0.1, you calculate 1 over 0.1, the multiplier is 10 times. Okay. Now, if the central bank up the required reserve ratio to 20%, that means when we use a formula, we take 1 over 0.2, the multiplier goes down to 5 times. Okay. And when the central bank increase the required reserve ratio further to 40%, the multiplier effect goes down even further to 2.5 times. So you can see when you force the bank to keep more money with them, that means they cannot lend out so much, the multiplier effect gets lesser and lesser. Okay, and vice versa. If you allow them to keep lesser and lesser money as a requirement, the multiplier effect will go up. Okay, so this required reserve ratio is controlled by the central bank. Okay, so in this way, the central bank controls the amount of commercial bank lending. Okay, by setting up this required reserve ratio, which is mandatory for every commercial bank to follow. So the higher the ratio, the lower the multiplier, and vice versa. Now, just now we calculated that from a $100 deposit based on 20% triple R, the banking system should have been able to create $400 worth of new money. Now, sometimes the banking system will not be able to do that, and that is because number one, there could be leakage. Now, what is a leakage? A leakage is when a person withdraws money out of the banking system. Now, for example, somebody borrows money from a bank. Okay, let's say borrow $100, and the person took out the $100 and doesn't set up another new account, just took the $100 and spend it or give to somebody. Once the new account does not multiply, the money creation will stop. Okay, so a leakage is when a customer or borrower takes money out from the banking system. Okay, now if the leakage occurs at the early part of the lending process, just now we had bank A, bank B, bank C. So if the leakage occurs earlier in the process, like in bank B or bank C, then the leakage will be very severe. That means the the commercial banks will not be able to create anywhere close to the $400 that we calculated. Okay, so it depends on when does the leakage occurs. But a leakage typically means that the banking system will not be able to create the full amount of how we calculated using the formulas. Okay, now of course the second reason is when banks don't want to lend, when they keep excess reserve. When they don't lend, obviously there's no money being created, or they lend out less. Okay, less money will be created. Now, this is the end of the money and banking lecture. So what you have to do is to go online and take the self-test by clicking onto the OCL tab and to write your reflections on your learning, your strengths and weaknesses in any of parts of the two topics, which is fiscal policy, tutorial, and this money and banking lecture. Write in your class blog to complete the process of your learning in this OCL. Just make sure that you also looked at the fiscal policy tutorial. If you need to recap on fiscal policy, the fiscal policy online lecture is uploaded on the LMS in the fiscal policy tab. Okay, see you guys when you are back.